Welcome to CoreLogic's housing market update for April 2025. Brought to you by onthehouse.com.au. Australian property values recovered to new record highs in March, reversing the recent 0.5% dip in values between November and January. CoreLogic's National Home Value Index was up 0.4%, continuing the growth trend for the second consecutive month, following February's 0.3% rise. The monthly rise in values was broad-based, with every capital city, except Hobart, recording a positive change, along with each of the rest of state regions. The monthly change across the capital cities ranged from a 1% gain in Darwin to a negative 0.4% fall in Hobart. Improved sentiment following the February rate cut is likely to be the biggest driver of the turnaround in values, along with the cut's direct influence of a slight improvement in borrowing capacity and mortgage serviceability. Sydney and Melbourne look to have turned a positive corner, with values rising across both cities over the past 2 months. Although Sydney home values remain 1.4% below their record high. In Melbourne, where the downturn's been more long-running following a March 2022 peak, housing values remain 5.6% below their record high, despite rising by 0.9% over the past 2 months. Housing values are still increasing across the mid-sized capitals, however, the pace of gains has slowed noticeably, especially in Perth, where the downward revisions over recent months have seen housing values remain virtually unchanged since October last year. Perth home values have led the 5-year upswing amongst the capitals, rising by 75.4% since March of 2020. The change in housing values across the different price points, or value tiers, has started to even out, following a clear outperformance from the lower quartile of the market since mid-2023. The rate of change across the value segments is now converging. This was most apparent in Sydney, where upper quartile values have increased by 0.6% over the past 3 months, compared with a 0.3% rise across the lower quartile. Earlier research demonstrates that relatively expensive housing markets have historically shown stronger responses to reduced cash rate settings, especially houses in Sydney and Melbourne. Most of the remaining capitals continue to see the lower quartile record a higher rate of change relative to the upper quartile, however, the gap is getting smaller. Regional housing markets continue to outperform the capitals, with the combined regionals index rising by 0.5% compared with the combined capitals up 0.4%. However, the growth trajectory looks to be converging as the capital city trend accelerates. Rental values are also at a record high, with the national rental index up a further 0.6% in March, in line with the last month's increase but well below the 1% increase seen this time last year. Dwelling rents rose across every capital city in March, but the annual growth trend is clearly slowing. It's dropped back from a peak of 9.7% over the 12 months ending November 2021 to 3.8% over the past year, marking the slowest annual change in rents since March of 2021. Perth home values are up 0.2% in March, continuing a period of stabilisation across the Western capital. Housing values are virtually unchanged in Perth since October last year. The slowdown in growth comes after a 75.4% gain in values over the past 5 years, creating some affordability challenges alongside less demand as investment activity and population growth slows. As the market slows down, listing numbers are rising, tracking 9.1% higher than a year ago at the end of March, but still well below average for this time of year. A year ago, homes were selling with a median of just 9 days on market, rising to 19 days over the March quarter of 2025. With 2 months of growth in Australian housing values now on the scorecard, it's looking more convincing that the positive turn is more than just a temporary recovery, but a material upswing in housing values remains highly unlikely. On the upside, we have a gradual easing in monetary policy, cost of living relief, we have income growth, tight labour markets and improved sentiments, all which are likely to support housing sector activity. On the flip side, a variety of headwinds are likely to at least partially offset the tailwinds, keeping value growth contained. The rate-cutting cycle is likely to be a drawn-out one. Housing remains unaffordable, population growth is reduced to more normal levels, and housing credit policies remain risk-averse. Factoring in a reasonably bullish 75 basis point cut to the cash rate for the remainder of the year, which would take the cash rate to 3.35%, implies that interest rates will remain above the RBA's estimate of the neutral cash rate throughout 2025. Until home loan serviceability improves more substantially, it's hard to see housing markets moving into a material growth trend. Further cost of living relief announced in the federal budget should also help to support household balance sheets, although the variables may change following the May 3rd federal election. Alongside real growth in household disposable incomes, which the RBA forecasts at 2.5% over the 2025 calendar year, prospective borrowers may find it easier to save for a deposit. In fact, we're already seeing a consistent pickup in the household saving ratio, albeit from exceptionally low levels. Labour markets are holding tight with a national unemployment rate of 4.1%, but there are some signs that labour markets are loosening. The February labour force update was relatively soft, showing the largest month-on-month fall in jobs since December 2023, taking the trend in annual jobs growth back to 1.9%, which is the lowest annual change since October of 2021. Measures of consumer sentiment have been rising, fueled by improvements in inflation outcomes, cost of living relief, and growing certainty that interest rates will come down further. Consumer sentiment and housing activity have historically shown a really strong relationship, so the improvement in sentiment should help to support sales turnover. Another downside factor for demand is that housing affordability remains stretched, with the national dwelling value to household income ratio on par with record highs at 8.0 at the end of last year. Home loan serviceability was also at a record high. Assuming a household on the median income purchased the median value dwelling with a 20% deposit, they'd be dedicating 50.5% of their gross income on mortgage repayments. Lower population growth is also denting demand. Population growth in the September quarter was back to 0.4%. That's on par with the pre-COVID decade average. The slowdown has been driven by a sharp drop in overseas migration following its peak in the first quarter of 2023. As of September 2024, quarterly net overseas migration numbers have reduced by 46%. Although demand-side pressures are easing, new housing supply is likely to remain constrained amid high costs, scarcity of skilled trades, and compressed profit margins. Even though population growth is easing, the cumulative undersupply of housing will take some time to address. Housing construction costs are still rising from an already high base, creating ongoing feasibility challenges for builders and developers, and the competition for trades with the infrastructure sector is likely to persist for several years at least. Low supply is another factor that could support further growth in values. Overall, it's likely we'll continue to see housing prices tick higher from month to month, with less diversity between the capitals as annual growth rates converge. The prospect of a surge in housing values as interest rates fall looks highly unlikely. What's more probable is a mild growth rate underpinned by a gradual fall in rates and ongoing supply-side challenges. As always, there's been a lot to cover in this update. If you'd like to dig a little deeper into these trends, check out the research and news pages of the CoreLogic website.